This video goes through the risk and return functionality. So basically, after we have performed the market simulation, the views and the stress testing, and the portfolio optimization, then we probably want to analyze the risk and return characteristics of our portfolios. It could also be that we apply this functionality to our current allocation to assess whether we are positioned as we want to. So first we start with a bit of theory, and actually in this case it's quite straightforward. It's probably easy for most of you to understand the concepts compared to some of the other methods that we've been going through. So first, one of the analysis that you can do is just to decompose the risk that you have estimated. So one thing is knowing that the CVAR of our portfolio is 10%, but another interesting analysis is to know where actually these contributions to these 10% they come from. And this is what we call marginal contributions to risk. And for any of the risk measures that we work with, we can actually decompose it in this way, such that the risk is the sum of the individual exposures multiplied by their marginal contribution to risk. And we can also formulate this as vectors, where we have the exposures vectors, and then we have this gradient vector at the end, and then we will get the risk of our portfolio. So of course, usually we are not in doubt about how the exposures are. This is the result of an optimization of the current strategy that we have. So the challenge can be to compute these gradients. For something like the variance, this is very easy. You just use the covariance matrix. But for CVAR and other risk measures, fully general distributions, it becomes a bit harder. But in the worst case, we can always compute it numerically if we don't have closed form solutions. All right. So we also can perform this decomposition to the portfolio's expected return. And actually, in this case, it becomes more straightforward, but there are more things that we need to keep track of. So here you can see that we can decompose the portfolio's expected return into the marginal contributions after holding cost from each exposure that we have here. So this is quite straightforward. And then minus the transaction costs that we would have to come to this portfolio. So basically, if we do portfolio optimization, of course, we want to optimize our portfolios after transaction costs. And we have to account that if we reallocate in some way, that there are some transaction costs associated with this trading. So actually, this is why we have this exposure object, because it will keep track of which instruments you have an exposure in and which potential initial exposure you had. So when you do portfolio optimization, we actually return it in this exposure object, because then we can compute these marginal return contributions from some initial portfolio. You could also just be considering to change your portfolio in some direction and then just want to estimate how are the marginal contributions to the expected return, and then specify your current allocation right now. So this is an important also separation in the optimization, especially if we do it with the tracking error constraints, because the tracking error will be against a benchmark portfolio or reference portfolio, while the trading costs are of course against our current allocation. So there's this separation between E0 here and the benchmark in this case. All right. So when we analyze these marginal contributions to risk, we can also define something that we call the gross risk. So basically, the gross risk, this is just when we have the individual standalone risks of the different instruments that we are investing in, and then we subtracted their marginal contribution to risk. And then because we work with coherent risk measures such as the CVAR or even the variance, or lower semi-absolute deviation, then we know that this term will be positive. Because basically we have this diversification principle. So the way that we define these gross contribution to risk, that's just the standalone risk, and then this is the marginal contribution, so after accounting for diversification interactions. We also define something as the marginal diversification here. So this is just the exposure multiplied by this quantity, so that we can see how much each exposure actually contributes to the diversification of the portfolio, and the diversification is the difference between the gross risk contribution and the marginal risk contribution. So please just look at these equations and think about it, and I'm sure that you will realize that it's quite straightforward. Otherwise, you will see it in the examples where, yeah, it should make sense for you. All right. So then we also will have some examples with this portfolio risk budgeting exercise. And basically, when we perform portfolio optimization, benchmark relative portfolio optimization with tracking error constraints, and this is also something that you can read about in the portfolio construction risk management book, we can introduce an important separation if we perform the risk budgeting in a correct way. So basically, if we put a target on the overall portfolio risk and the tracking error, because then we implicitly also put a constraint on this correlation or the diversification term. Assuming that we have a fixed benchmark risk or a fixed strategic allocation risk. This is something that you can read much more about in the portfolio construction risk management book, but we will see some examples where we use this formula for variance, and then we perform some stress testing with entropy pooling to see the different effects that we can have. So, of course, as with so many things, variance can be expressed very, very nicely, but it's also a gross oversimplification of how reality is, because actually you can also perform this analysis for CVAR, but the diversification term is just much more general because we have these fully general distributions, but since it is a coherent risk measure, you can still decompose your CVAR in this way. And again, this is something that is described in the portfolio construction and risk management book. All right, so let's now go to the Python examples.